What happens when a Hong Kong developer faces a $940 million debt restructuring risk amidst an 18.3% office vacancy rate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoan. Let's get right to it. Parkview Group, a Hong Kong-based real estate developer, has become a case study in the fragility of China's commercial property sector. As the firm races to restructure its $940 million loan tied to its flagship Beijing complex, Parkview Green, its struggles highlight systemic risks in a market grappling with liquidity constraints, high vacancy rates, and a tightening credit environment. For investors, the company's efforts to leverage non-traditional assets, such as its art collection, and pursue private refinancing offer insights into broader industry stress and potential opportunities in asset-backed debt and distressed mall repositioning. Parkview's immediate challenge is maintaining a 55 million yuan reserve in a dedicated bank account to service its Beijing loan. As of early 2025, the firm was 20 million yuan short, with a March 17th deadline to replenish the funds. Failure to meet this threshold could trigger a default, compounding its existing debt woes. The company's attempt to secure a loan via its art collection, valued at over Hong Kong $200 million, collapsed due to logistical hurdles in transporting and warehousing the artworks. This underscores a critical lesson. In a tightening credit environment, even high-value collateral may lack the liquidity to meet urgent obligations. Parkview's pivot to private credit facilities further illustrates the sector's shifting dynamics. Hong Kong banks, wary of developers with cash flow issues, have tightened lending terms and increased collateral requirements. Parkview's efforts to secure a $2 billion syndicated loan by July 11, 2025, reflect a broader trend of developers seeking alternative lenders, including private equity and institutional investors, to bypass traditional banking constraints. However, these strategies come with higher costs and greater scrutiny, amplifying the risk of margin compression. Parkview's plight is emblematic of systemic pressures in China's commercial real estate sector. Beijing's office vacancy rates hit 18.3% in 2024, driven by economic slowdown and reduced demand for retail and office spaces. Parkview Green, once a symbol of luxury retail and commercial innovation, now struggles with low occupancy, mirroring challenges faced by mid-sized developers across the country. The sector's reliance on rental income as a primary revenue stream has proven vulnerable to macroeconomic shifts, forcing firms to explore asset sales and repositioning strategies. The failure of Parkview's art-backed loan also highlights the limitations of non-traditional collateral. While high-value assets like art or luxury real estate can serve as temporary liquidity sources, their illiquidity and execution risks make them unsuitable for long-term refinancing. This has pushed developers to prioritize asset monetization, such as selling underperforming properties or converting commercial spaces into logistics hubs to meet debt obligations. Despite the sector's challenges, Parkview's situation reveals actionable investment opportunities. The growth of China's asset-backed securities and commercial real estate investment trusts market offers a pathway for investors to capitalize on distressed assets. For distressed mall repositioning, the bifurcation of the retail sector presents targeted opportunities. Luxury tier malls continue to attract tenants, while mid-market and lower-tier properties face high vacancies. Urban renewal initiatives, supported by policy banks and institutional capital, are transforming underutilized retail spaces into mixed-use hubs. For example, logistics operators are repurposing big-box retail spaces into last-mile distribution centers, aligning with e-commerce growth. Investors with a value-add mandate can capitalize on these trends by acquiring distressed malls in Tier 2 cities and implementing ESG-aligned retrofits, such as energy-efficient HVAC systems and flexible floor plans. Parkview Group's debt restructuring efforts underscore the urgency of liquidity risk management in a sector facing structural headwinds. While the company's immediate survival hinges on its ability to secure new financing, its broader implications point to a market in transition. JLL Capital Markets has arranged a significant financing deal for Urban Edge Properties' portion of Shoppers World, a leading retail center in Framingham, Massachusetts. The financing amounts to $123.6 million for this 752,000 square foot property. JLL Capital Markets worked on behalf of Urban Edge Properties, securing a 4-year fixed-rate loan. Shoppers World is strategically located at 1 Worcester Road, positioned at the intersection of Route 9 and Route 30. This location offers exceptional visibility and access within the Boston Metropolitan Statistical Area's premier retail corridors. The property benefits from strong connectivity to major transportation routes, including Interstates 90, 95, and 495, providing convenient access to Boston and surrounding suburbs. The retail center boasts a 99% lease rate and features a robust lineup of national retailers such as TJ, Maxx, Marshalls, HomeSense, Sierra Trading Post, Best Buy, and Dick's Sporting Goods. Investment-grade tenancy accounts for 54% of gross rent, with 97% of the gross leasable area occupied by national tenants. Scott Ies, along with Alex Stakos, Amy Lucerarian, and Parker Morrison from JLL Capital Markets' debt advisory team, represented the borrower. Iesi highlighted Shoppers World's appeal, noting its 8 million annual visitors and over $100 million in reported sales volume. Stakos added that the center's dominant market position and diverse tenant mix contributed to an exceptional financing opportunity. JLL Capital Markets is a comprehensive global provider of capital solutions for real estate investors and occupiers. With over 3,000 specialists worldwide and offices in nearly 50 countries, JLL offers investment sales and advisory, debt advisory, equity advisory, and recapitalization services. Urban Edge Properties, a New York Stock Exchange-listed real estate investment trust, focuses on owning, managing, acquiring, developing, and redeveloping retail real estate in urban communities, primarily between Washington, D.C., and Boston. The company owns 72 properties totaling 17.1 million square feet of gross leasable area. Navigating uncertainty in commercial real estate is a challenge, and the outlook through 2026 is filled with both risks and opportunities. As we examine these trends, it's important to consider the multifamily sector first, which remains a strong performer despite economic fluctuations. In regions like Kitchener-Waterloo, London, and Cambridge, Ontario, multifamily developments continue to attract investors due to stable demand and favorable market conditions. This is mirrored in the United States, where cities like Austin and Denver are experiencing similar growth in multifamily housing, driven by population influx and urbanization. Tenant leasing dynamics are also evolving, with a noticeable shift towards more flexible lease terms. This trend is particularly evident in the industrial sector, where demand for logistics and warehousing space is surging. In Ontario, industrial spaces near major transportation hubs are seeing increased interest from both local and international tenants, reflecting a broader North American trend where e-commerce growth fuels the need for efficient supply chain facilities. When it comes to office spaces, the landscape is marked by a cautious optimism. In cities like Kitchener-Waterloo, where tech industries are prominent, there's a slow but steady return to office environments. Companies are reevaluating their space needs, often opting for hybrid models that accommodate remote work. This mirrors the situation in tech hubs across the United States, where flexibility in office usage is becoming a standard practice. Retail, on the other hand, is undergoing a transformation. In Ontario, as well as in American counterparts, retail spaces are being repurposed to cater to changing consumer behaviors. The rise of mixed-use developments is a notable trend, where retail is integrated with residential and office spaces to create vibrant, multifunctional areas. This approach not only enhances community engagement, but also maximizes the utility of underperforming retail properties. Lastly, other commercial sectors, such as hotels and general commercial opportunities, are navigating a complex landscape. In Kitchener-Waterloo and similar markets, hotels are focusing on adapting to new travel patterns and consumer preferences. In the United States, the hospitality industry is similarly adjusting, with an emphasis on enhancing guest experiences and leveraging technology to attract visitors. Now let's turn our attention to a significant development project in Hawaii. The state of Hawaii is planning a massive $1.4 billion transit-oriented development on 170 acres of state-owned land in East Kapolei. This ambitious project is adjacent to the Hupili master-planned community and aims to transform the area with a mix of housing, a hotel, and commercial spaces. The development is a response to the growing demand for jobs and services in West Oahu. As the region continues to expand, the need for integrated communities that combine residential, commercial, and hospitality elements becomes increasingly important. The project's transit-oriented nature is designed to enhance connectivity and accessibility, aligning with Hawaii's broader goals for sustainable urban growth. This initiative is part of Hawaii's strategic efforts to address housing shortages while also boosting economic development. By incorporating commercial spaces and a hotel, the project is expected to create new job opportunities and stimulate local businesses, further supporting the community's economic vitality. The planned development near the rail station in East Kapolei underscores the potential for transit-oriented projects to drive regional growth. By focusing on accessibility and mixed-use development, Hawaii aims to foster vibrant communities that cater to diverse needs, from housing to employment and leisure. As we look to the future, such projects highlight the importance of strategic planning in urban development. By integrating transportation infrastructure with residential and commercial growth, Hawaii is setting a precedent for other regions to follow, showcasing how thoughtfully designed developments can enhance quality of life and economic resilience. That's all for today's episode. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoon. See you on the next one.